welcome on board Deven Choksey and find out what he's making of the market temperament right now. Deven, hi, good morning. Great to have you in the show. Deven, at the fag end of the earnings, tell me what stood out for you, because while technology has been mixed, banks have been steady, automobiles mixed, Maruti clearly the eyesore there, FMCG, again, one would say flat, but Dabur really stuck out like a sore thumb. And oil and gas, Reliance clearly outperformed.
Good morning, Aisha. Well, I think clearly the winner of the pack remains the banking segment. And in banking segment, we are basically experiencing the corporate lending as well as the retail lending books growing for most of the banks. With a 20% kind of a growth in the loan book, I think they remain pretty solidly placed as far as I think the outlook going forward is concerned. Also important point that in the rising interest rate scenario, many of these corporate banks been able to maintain their CASA ratio well, as a result of which the liability side remains, I think, pretty comfortable with the higher proposition of NIM continuing for them. So all in all, put together, lower amount of, I think, the NPS, better management of the liability side in form of collection of deposits, and higher amount of growth continuing from the loan book side. I think so. Bank remains clear winner, clear performer, outperformer, as you want to call it. Second important area where I find that I think things are relatively good are the companies which are consuming commodities. The commodities consumption, both in food category as well as in industrial category, the cost has come down, and as a result of which, most of the FMCG companies, including Britannia, have shown remarkably good performance. And at the same time, this performance is coming from the tier 2, tier 3 cities. That means they are of first 30 cities and they are going into the rural markets. That is very, very important for higher consumption and sustaining of the higher consumption. At the same time, in the industrial commodity segment, auto ancillaries particularly looks relatively more favorable at this point of time, because the basic commodity prices, the metal prices have remained subdued, and I think likely to remain subdued going forward. Should that situation continue, then auto ancillaries would look relatively better performance stocks. Also because of the fact in auto, the demand scenario continues to remain buoyant. So these are the two main key takeaways as I see it, I think, from the entire result season. One on the consumption side in FMCG and auto ancillaries and autos. And on the other side, I believe, I think the banking stocks, they remain clearly winners in this entire result announcement up till now.
All right, that's Deven's assessment of the earnings season. But let's shift gears then. Which are the stocks on the editor's radar? Interesting names that we've picked out today. Mankind Pharma, the cynosure of all eyes today. And it is a well-established company as well. We are all looking forward to the listing, and all experts are saying that it is going to be at a healthy premium this time around, given the kind of grey market action. Macquarie as well said that it's well positioned to double its profit by FY26.
You got to introduce the company and say, okay, a pharma company, but it's a pharma company which gets more than 97% of its revenue from the domestic market. So it's a pharma company which gets almost its entire cash flow from the Indian market. Now that's the differentiating factor. Why is that a differentiating factor? Because if you look at any of the other Indian pharma companies, whether it is Sun Pharma, even a domestic focused company like Cipla, they don't get more than 40% of their total business actually from the domestic market. That data point will just come up on your screen. That's part one of the story. Part two of the story, if you're a domestic focused pharma company, there you go, that's the number which tells you that Mankind gets 97 and Cipla and Lupin don't even get 50. Torrent, which is a slightly higher in terms of market share, but 50% is still non-India. This, I think, is a differentiating factor. This means that there will be visibility in the numbers and cyclicality would not be there. Unlike the US generic market, in India, the drug price trends are not always very volatile. Second, the return ratios, I think, are very decent, whether you look at return on equity or cash flow generation. That means it will command a strong P multiple, which will be certainly higher than a Sun Pharma and a Lupin, which means it will be trading at the higher end of the P multiple. So then what is the comparison? I don't think it will command as a P multiple which is as strong as MNC pharma companies, but it would be a discount to that. So you bake in that discount and you say, where can the stock open? I think a 10 to 15% appreciation and maybe some follow-up buying for Mankind Pharma after that cannot be ruled out. Which is the growth market in the world? It is India. Why is it growing? Because Indians are addressing their needs, because per capita is going higher. So we are buying branded apparel, branded watches. We're spending more in terms of healthcare, and they have a strong presence in the chronic care, which is where I think the advantage for Mankind Pharma would be. So I'm not using superlatives to describe Mankind Pharma, but I genuinely feel that this really could be the listing of the season.
Listing of the season, okay, that's Nikunj's word. Return ratios looking favorable, as well as the P ratio, all of that working well, and of course the domestic business. Let's move right on then. It's interesting because we've been talking about the food delivery space and of course the two dominant players, Zomato as well as Swiggy. And it's interesting in terms of the kind of market share that they hold and the fact that they, in terms of their peak valuation as well, they've come off.
Okay, you must just remember that there is a very big difference in Swiggy and Zomato. Of course, they both deliver food, so that's not the difference. The difference is Swiggy is not listed and Zomato is listed. Since Zomato is listed, it is an auction market where prices changes on a daily basis. From the peak valuation, Zomato has come down from about $15 billion to the current valuation of about $6 billion. For Swiggy, what Zomato, because it's listed, the price discovery happens on a daily basis. For Swiggy, it is happening only when the existing investors or an external valuer, they come out and change the entire underlying valuation. So what Zomato has experienced 6 months ago, Swiggy now seems to be experiencing now. That's a very big difference. So for those who are thinking that, Swiggy's valuation has come down and it's going to have impact on Zomato, no. Second, it is also important for us to understand that since this is the buzzword right now, ONDC and I'm getting my burger and pizza at the 50% discount, these are very early days. While I'm not undermining the impact of ONDC, it's a great idea and it is a platform which will have a great impact in terms of how e-commerce in India would be done. But for me to imagine that right now they would be in challenger, but to imagine that they could be changing the food delivery business in a disruptive manner, it's too early. I mean, imagine a restaurant, you can only focus on micro deliveries. You will have to invest in personnel. You will have to buy two-wheelers. You will have to get into more HR ka management jhanjat. Do you really want to invest in that? I think it would be a bit of a struggle. So I think that is an evolving process and it could take a couple of years before we realize that how the food delivery dynamics would change. So to cut a long story short, Swiggy impact, zero. ONDC, I think is work in progress.
Yeah, so it's too early to tell. So that's interesting, Aisha, as we flagged off these two stocks on the editor's radar.
Oh yeah, absolutely. Deven, in fact, wanted to get your thoughts in as well on Mankind Pharma, whether the IPO was a subscribe and for those who did not get the allocation, what next?
I think the at the IPO price, the stock was valued at around 30 times the price earning ratio. And should the company continue to grow at a pace at which it has demonstrated in past, then this listing of the IPO under offer for sale could possibly result into sustained price earning ratio going forward as well. Now that is going to be somewhat a challenge as I see it. I think largely because of the fact that I think the growth sustainability is something which we are not unfortunately very clear about. Plus, I think the price performance point of view, one should then probably I think it will remain steady from here on because largely that hangover of offer for sale has gone now, and as a result of which I think the price performance remains steady. But the growth in earning is something which I think we'll have to experience going forward as well. Otherwise, I think the other fundamental story as far as the company is concerned, they remain intact with the valuation remaining relatively on an elevated side. So unless I think you get price discount in the market, probably the margin of safety, as we call it, as I think, is not available in this particular stock.
Right. Okay, that's the take coming in on Mankind Pharma. We're awaiting that listing. Let's talk about a couple of buzzers in trade yesterday. There was, of course, Marico, which shot up about almost 8%. Manappuram made a decent comeback, as did IndusInd Bank. Deven, do you think now with the IndusInd Bank clarification on the management rejig, all the dust settles down? Yesterday, the stock as well recovered all of Friday's losses.
I guess so, because I think on the fundamental side of the business, the business focus remains, I think, pretty strong in the areas of the lending, commercial vehicle lending, which is there, I think, relatively, I think, a stronger play, and also some other industries, I think, in which they are focusing systematically. So, from a perspective of, I think, bank looking at higher amount of growth going forward, I think remains very high. in previous years and quarters, I think the larger amount of issue was also with the balance sheet adjustment, particularly the NPAs. I think that part is also over. So I would think that given the kind of strategy in place, given the kind of market growth and opportunity in place, I would think that IndusInd Bank could possibly remain a steady to better performer than its previous past.
Well, the CTO resigns, the stock falls, and then it recovers. But I think it will have. IndusInd Bank has lost their mojo after the IL&FS crisis. They were commanding at a 3 to 3.5 time price to book, just little bit below HDFC Bank at some point in time. But that halo effect which it had of superior growth and great, great growth cycle, I think that is really behind us. In fact, it has underperformed. It has underperformed. I mean, this is one of those stocks which has not participated, Kunal, in this banking rally, frankly.
Yeah, and it's strange because, from the September 2022 lows, IndusInd Bank was, rather July 2022 lows, IndusInd Bank was at 750. And in the second half, till I think the month of December 2022, the stock at one point was almost at 1250 levels. So when you look at the price recovery, when you look at the recovery in terms of where the stock was in a matter of 4 or 5 months, it was a very stellar recovery for IndusInd Bank. So all it had to do is, after that 4 months of correction for the markets, the stock had to just made a comeback again and cross that 1250 mark. But it's been unable to do that even in the last 1 month of price recovery for most of the private sector banking names. So there is some concern for the stock, and it's getting reflected into the stock prices. My sense is that the volume patterns are still not as strong for IndusInd Bank as it was in the second half of 2022. That is why the stock is taking a lot more time. Maybe over the next couple of months, we may expect some sort of a breakout to happen, but then I think it's better to wait and watch for the breakout rather than anticipating the breakout for IndusInd Bank.
Deven, Choksey, what do you make of this news in Swiggy? The P investors have brought the valuation down. Do you see that impacting the underlying stock price of Zomato?
I don't know, Nikunj, I think whether it will immediately impact the underlying stock price, because it's not about only the cost factor at which you are delivering the food items. It's also about, I think, the convenience, and it's also about the efficiency under which it is being delivered. So yes, I think there is going to be a pressure on the margin, definitely, for sure, because out there, when the competitive prices are lower, there is going to be pressure on margin. But as far as the demand scenario is concerned, I would think that I think both Zomato and Swiggy would continue to experience the higher amount of order intake, largely also because of the fact that the customers are quite used to the kind of services that they have been offering, and those habits don't change normally so easily. So from that point of view, I would rather like to believe that I think the journey would continue, except the fact which I mentioned, the margin pressure would be probably something which is reality in the near term. So let's see how exactly I think this particular model pans out. Whether the network of ONDC would continue to sustain offer or continue to offer the discount on a sustainable basis, not too sure on that particular aspect. And should that be the situation, that if they find out effort to give higher discount, then possibly I think one will see the recovery back into the perception and the valuations thereafter into this particular segment. But we'll have to wait and see. In the near term, definitely I think the situation is slightly going against, I think, these both companies as far as the margin perspective is concerned.
Right. Naresh, help us with the charts of both Paytm as well as Zomato. Paytm, of course, on the back of that, commentary after its earnings and the earnings, the fact that the loss has now narrowed in the Q4 numbers, and that zoomed up yesterday.
So, like I've been saying, the view is there are three names in the new age companies which have made classical bottoming out formations. One is Paytm, one is Zomato, and the other one is PB Fintech. Now, Paytm is now setting up for the next leg of the move, where it gets into a momentum move going forward, ideally. So, if you look at the technical structure, it made the lows around 500 levels in November of this year, made a low around 520s back in March, April of last year. Recently, we did see a move from 550 to 750 back in February. Again, saw a retest of 550 levels. And now we've come back to that 750 mark yesterday. Now, that's a start closer to 730, 740 mark. Now, that's a start. If we sustain about 740, it starts up the next leg of the move, which gives us a target price of 840, 850 levels, which was done in the last August. So technically, the shaping up is very clear. gone through a minimum of 8 to 12 months of consolidation, which is ideally needed in stocks which fall this 50%, 60%. And then you start a new trend. So positive on Paytm would have a short-term target price of 840. But overall, structurally, the trend is changing. Same is the case with Zomato. The stock fell from 160 levels all the way down to in the 50 to 40 band. Tested those levels for the last 8 to 12 months, 3 times. Then over the last 2, 3 months, made a consolidation between 50, 56 levels, made a breakout over there. Now we are taking a little bit of a consolidation here at 60, 66. So the highs for the last 1 year in this consolidation period is 75. So that is the target I have, closer to 75, 80 in the short term. And then if that breaks, we get into the much bigger trend. But overall, positive on these three names, which look interesting. PB Fintech similarly made that breakout and continue. So out here, I would be bullish on Paytm as well as Zomato at current prices.
The peak to getting smashed and from there a V-shaped recovery. That's the definition of how new age tech has actually moved in last 18 months. But in this episode, in our series CEO at Work, we this time visited the manufacturing facility of India's largest solar panel maker, Vare Energy. They are the 7th largest solar panel exporter in the world, and this in a sense is a clear indication of how the true blue renaissance in the Indian manufacturing sector has arrived. From an unknown brand to an unforgettable company to a journey which started 15 years ago is now picking up steam. So let's just show and let's just bring our viewers up to speed with the excerpt of our interaction with the chairman of Vare Energy.
Today, it gives me great pleasure to talk about the Vare Group, a group which is championing the entire energy transition in the world.
India has been a forefront in manufacturing for many years. Now with the government policies and the demand across the globe for the alternative supply chains, I think this is a very good opportunity that we as a whole country, we can become another manufacturing hub for the world. And Vare was always in a forefront for last 30 years in a manufacturing. Of course, solar we started a little bit late, but whatever we were in manufacturing, we took the leadership at the global level.
All that mega exclusive coming on ET Now tomorrow entire day. I'm going to switch gears and go back to the comeback in some of the pharma names. And Naresh, Mankind listing is today, but before that, we've seen a sizable comeback in a Cipla, in Aurobindo, in a Lupin. Do you think this is dead cat bounce or a change of trend?
So out here, what is very clear is the two sectors which did well with the whole COVID was IT and pharma. They've gone through that upcycle, then they've gone through this down cycle, and now every stock is making different moves in the segment. So if you were to look at the way Dr. Reddy's has been moving up, that's a fresh new trend, which is where the stock is not very far away from the previous highs, the all-time highs, relative to rest of the names. So the stock is 10% away from an all-time high. But a lot of these names, something like a Lupin is still down 60-70% from the highs in 2015. So you have different trends altogether. Aurobindo Pharma, even after the current move of almost 50%, is still below the prices it was in 2019 and 2022. So overall, the view is one has to take a stock-specific call rather than the whole sector. There could still be names which could continue on the lower end and not recover. So the view is we are setting up for some of the names which are showing a strong bounce back. So there's a Biocon, there's a Glenmark Pharma. A lot of these names were disregarded in the whole move of 2021-22. So that's interesting. Dr. Reddy's remains the stronger one in the large caps. Sun Pharma, although has been relatively stronger, momentum continues to lack here. So out here, I would be waiting for a tick above 1030. And that is where I would be interested in Sun Pharma the most. So for now, it's a bet on stocks like Biocon, Glenmark Pharma, which have done terrible over the last few years. And then the other bet is to go with the names like Dr. Reddy's and Sun Pharma, which have done relatively better after being in a downtrend from 2015.
Okay, I'm getting a sense then from you, Kunal, on the charts. Some stocks that saw a breakdown in yesterday's trade. Aditya Birla Fashion, for instance, on the charts. And what about a Bank of India? Of course, it was a slew of PSU banks, but Bank of India in particular?
So, in fact, most of the PSU banking stocks, as you
Yeah.
rightly said, they were under selling pressure. But I don't see any major structural change for Bank of India. I think the stock went through a correction, 2 days of correction for Bank of India. I think from 87 or 88, the stock had made a high in the previous week on Friday. The stock made a low of 81. So again, it's a correction of 5-6 rupees for the stock price, 7-8% approximately. But nothing structural, changes in terms of the chart patterns. The stock is still showing signs of good volumes built up over the last 4-5 days prior to the correction. And then I think at current levels of 80-81, it's actually come back towards a good attractive zone to go for a contra buy. And for ABFRL, I think what actually transpired is the last 7-8 months back, when the stock was almost at 350-360 levels, it was looking extremely strong, in terms of a breakout, but then followed 5 successive months of price correction for ABFRL. So after this kind of clarification in terms of news flow, the last 5 months or the correction of that 5 straight months indicates that the stock was building up to that kind of a news flow for itself. Now that the news is out, I believe major part of the volatility could be out of the stock over the near to medium term. So traders who have been wanting to buy ABFRL because of the last 7-8 months of price correction downtrend for the stock, I think at current levels, because the news is out, the event is out of play for the stock price, it's a very good and attractive play from a medium to long term play. So I think at around 200, 205 levels, ABFRL could be a very attractive risk reward buy from a medium term play.
Okay, that's interesting, giving a view on some of the stocks that saw a breakdown in yesterday's trading session. Meantime, the street will also be closely eyeing in today's trading session what the outlook is on some of the companies that will come out with their numbers. Westlife, Chalet Hotels, Raymond, as we discussed, Godrej Agrovet. There's also Nazara Tech and Apollo Tyres. No Nifty 50 earnings that will be coming out today. Deven, any of the companies that I've mentioned, is there anything in particular, say a Westlife or a Raymond, Godrej Agrovet, Nazara, that you'd be watching out closely when it comes to earnings?
So, Evan, we don't have coverage on any of these companies per se, I think, at this point of time. However, would like to add few names out here. The results, I think, which came up for HFCL, Himachal Futuristic, I think they remain a little bit, I think, a promising bet at this point of time. And so is the possibility along with in Starlight Technology. These are the companies which are thriving largely on the network implementation under 5G. And I think they have suffered in past for a variety of reasons. But I guess I think the right reasons are now working for them. In case of HFCL, I think they are also getting into some of the defense items, I think, which are also basically, I think, going to be producing higher amount of revenue for the company going forward. So in my viewpoint, I think this needs probably demands a refresh attention onto them. They look relatively more promising, and given the kind of recovered results that we see, I think that should probably work for this company and the investors here after it looks like.
Okay, fair enough. That's the view coming in. And yes, indeed, when it comes to HFCL, you did see them come out with a fairly healthy set of numbers. The margins came in at about 10.8%, and even revenue growth was higher by about 21% on year. Meantime, let's just check in then as to what exactly the pre-open rates are at 9 a.m. and a little bit quiet, but yes, holding out above the 18,280 mark, at least on the Nifty and the Sensex as well. That is around the 61,645 mark in trade. Let's get in a take from you, Naresh, as to what the outlook is on, another stock that has been in the spotlight of late, and I wanted to get in a view on Alembic Pharma, given that the stock is above its 200 daily moving average, and there's also a Manappuram, that stock has seen a smart move above the 200 DMA.
So Alembic Pharma is interesting for the fact that the stock went through this whole upward cycle as well as downward cycle in the last 3 years. The stock went all the way down to the lows of 2018 to 2020. Interesting the fact that the whole pharma rally, the stock went up from 450 levels to 1100 and went all the way down to almost 450, 500 band. And now we've started reversing. So there is a good chance that the bottom is in place out here. One could look at it as a buy on dips going forward. A mean reversion trade although may not expect very large returns, but from any dips back to 560, 550, I would expect a slow and steady move towards 660 to 700 levels. Manappuram, on the other hand, would still be a stock which would be an avoid unless one has a view on the stock given the news around it. But technically, 105 is a strong support. Would remain in this range of 105 to 120, 25 levels for quite some time to come is the view. So out here, it's a tough one to trade. And even though if you remove out the current problems, the stock has been an underperformer for the last 1.5, 2 years. So one is better off looking at Muthoot Finance in the same sector, or look at a bunch of other NBFCs which are hitting 52-week highs like M&M Finance or L&T Finance only.
Okay, let's find out those mid-cap strategies then from our chartists. And Kunal, what are you looking at today?
So I'll be suggesting a buy on rate gain. That's a stock which has done exceptionally well. In fact, was one of the positional calls which I had highlighted a couple of months back. Yesterday, the stock gave a classical breakout, a 5x to 6x jump on the volumes compared to the last 1 month of average volumes for rate gain, and that was one of the key highlights for the stock price. Would suggest a buy with 424 as a target, stop loss at 377.
Okay, rate gain it is. A thumbs up from Kunal. What about you, Naresh?
So that would be a buy on Container Corporation. Continue to like the whole PSE segment one by one. This is a stock which has gone through the cycles of every time going to 550 and 750, 800. Over the last 2 years also made a bottom around 550. 550 to 600 was the price pre-COVID as well. So the stock is available at the same price as it was 3-4 years back. And now has started making a recovery. The last 3-4 months, the stock was in the range of 550 to 620. Over the last 3 sessions, we've seen a short-term breakout above the 620 mark. I would expect it to recover towards 700 levels, keeping a stop loss at 620 on this trade.
Gain and Concord, those are your top mid-cap ideas. Deven, before we let you go, the phenomenal rise that we've seen in railway stocks, that has clearly taken everyone's breath away. But what's your outlook given the fact that you've seen a very heady run-up and that's played out in the last 6 months to 1 month itself?
Yeah, I think most of the railway stocks are buzzing on the receipt of orders that they are having, and which is rightfully so, because I think these companies require a good amount of sustainability as far as I think their order book position is concerned and execution is concerned. So from that perspective, definitely market is justified in expecting the stock prices to recover, and they have recovered actually. However, I think important point which always remains in front of us that railway being remains extremely competitive segment on the margin front for most of the supplying companies, and that's where you don't have any chance of playing with any errors at this point of time, because I think their margin range is around 5%, 7%. And in the process, suppose if you end up hitting such kind of roadblocks like material prices going adversely against you or something, probably I think they can affect your margins, and that is what is required to be checked when you give higher amount of valuation to companies in railways. But in a normal situation, probably with the kind of growth that we are talking about in respective companies, maybe in some of the cases you justify the higher valuation, given the fact that I think they may be able to sustain the margins hereafter.
Right now, my view on railway stocks is very simple. That while government is committed to kickstart the railway capex, and if you look at the budgetary allocations for the railway sector, the budgetary allocation are the highest ever, which means the government is going to be allocating a lot of capital to railways. Railways is one sector where the ability to absorb that capex, I think, is very high. See, beyond a point, you cannot do roads because large part of the capex is already getting absorbed. But railways, both in terms of upgradation, also in terms of modernization, and also in terms of a fresh connectivity, it can really absorb that kind of an capex. What we are seeing is that there are a lot of railway capex stocks which have done rather well. Companies which historically have had a long-term relationship with railways are now enjoying the benefit of this renewed vigor in the capex cycle. But my limited point is that stock markets in the short term, first, they can always reprice the terminal value much ahead of the actual reality. So the railway business is a long capex business where the order book initially will look strong, but by the time you will execute some of these projects, it actually could take months. So my only fear is that while railway is a multi-year, multi-decade theme, multi-year theme at least, I think stock markets are pricing in a lot of good news 2 to 3 years ahead, which means that in the near term, if you bought the railway stocks with the view that this is going to be like a Jack and the Beanstalk story and it's going to continue to rise, you got to think again. Most of the railway stocks are no longer cheap. The run-up has been quite extraordinary. Weak hands have moved out, and I will not be surprised that the absolute gains what we've seen in some of the railway stocks could be behind us. We've already seen the post-over RVNL turn volatile. The circuit has gone down from 10% to 5%. From 20 to 10 to 5 now. So you got to be a bit careful in buying some of the railway stocks now. Now I think there is a lot of assumptions, and there is a little bit of froth which clearly is getting built up.
Kunal, do you see that on the charts as well, given that the stocks at 52-week high are a whole bunch of them, everything from a Texmaco, if we can just go back to that plate, RVNL, IRCTC, you've got a Railtel, IRCON, they're all at 52-week highs. Is the best behind us?
So not all stocks are at 52-week high. I think IRCTC is still lagging significant behind the all-time high levels for the stock on an adjusted basis around 1100 mark. Stock is trading at 600, 650 odd zone for itself. Yes, the likes of RVNL and many other railway names, Titagarh Wagon for example, that's a stock which is trading at a significant high. So what typically happens is that you have to distinguish stocks which move up in a jiffy in a very short span of time by a margin of 40-50%. For example, what happened to RVNL, whether you look at the last 1 month of charts or whether you look at the last 3 months of charts, the momentum is quite strong on the upside. But then there are other stocks which are also lagging significantly behind. There are some stocks like Titagarh Wagon which is scaled up in a very slow and steady and a gradual manner, breaking past about that 179 mark, which was on previous all-time high levels for Titagarh Wagon, and then the stock scaled up higher to levels of 250, 300 approximately. So I believe that the momentum has to be scaled into a zone where the stocks which are into a high beta zone, you drop your position size and you be a bit more careful over there. But for the likes of IRCTC, which I still believe is a very good buy at current levels, and be the likes of Titagarh Wagon, which I think is a strong positional buy from long-term play.
Right. Okay. That's the word coming in, and a couple of these railway stocks. And yes, IRCTC, the 52-week high on the stock was 774, low being, of course, 557. Currently, it's hovering around that 628 mark. So stand corrected at that. But what's the khabar and the buzz on D Street this Tuesday morning? Heavyweight Reliance Industries has been making the buzz lately on the possible listing of its retail arm as well as the demerger of